Okay. Good morning, ladies and gentlemen. I would like to thank Anne Low and Marco for inviting me to be virtually present in this opening plenary session. I would also like to welcome all of you on behalf of Boon Institute for Financial Economics. My last 44 days of research in Stanford and Silicon Valley have been most interesting, but I wish I'm there personally to welcome all of you there and to spend some time discussing with you. But since I can't, so I'm just going to summarize some of my findings in the last few months in the next 20 minutes. Accelerating technology advancement in computerization, communication, and automation will increasingly displace jobs faster than labor market can adapt. The result is persistent long-term high unemployment, and given the inverse relationship between unemployment and inflation, there will be little rationale for policymakers to raise interest rates. In a low interest rate environment, fractional reserve banking loses its potency. So the financial system is on the verge of massive disruption. And that's why we're here, innovative competitors operating on sleek business models and offering new alternative services are entering at the bottom of the market, where gross margins are low and latent demand is high. As these new entrants scale and progress through higher market segments, they will erode incumbent pricing power. And I think we have seen the video earlier on about banking, financial services, and banking still enjoy relatively robust margins, but this is more a function of regulatory protection than the actual value they create. Besides, they're tending to focus more on compliance and cost containment versus strategy execution. And I will apologize to any banker and financial institution colleagues in the audience. It is a slow death. So large, complex financial institution incumbent by tightening regulation, a silo mentality, and burdensome physical infrastructure are ripe for digital disruption. Asia and many others are investing heavily in fintech startups, software and app-based companies primed mostly to disrupt banks and other financial institutions, fund managers as well, and also insurance companies through the offering of alternative financial services. Growth in this area has been explosive. Investment in fintech was only 34 million US dollars in 2003. It increased to 930 million US dollars. And today, we look at last year numbers, depending on what your statistics is between 4 to 13 billion. And that is a substantial increase in investment in that particular space. The world has become more volatile and uncertain. It used to be that companies with high margins were the most attractive destinations for capital. These days, the most attractive companies are the innovative ones, like those in Silicon Valley, Singapore, London, Europe, and elsewhere with low margins, but high potential for scalability and a focus on consumer stickiness rather than cash flow alone. So there is already a lot of high-speed mobile broadband in the developed world, but in the developing economies, penetration is still quite low in the 20s and 30%. There is plenty of scope and opportunity here, and Google, Facebook, and those of you who are familiar with Guangqi, which is listed in Hong Kong, from China, are all in a race to connect the last few billion people to the internet through wireless. And of course, a lot of them are via the smartphone, and therefore the possibilities are profound when smartphone enter the equation. According to the World Bank 2014 Global Findex report, the worldwide percentage of adults with a financial deposit increased from 51% 4 years ago to an impressive of 62% today. But it is not the banks that are leading this change. Rather, it is the telecom, internet, and e-commerce companies that are bringing banking services to the unbanked and the underbanked. Traditional banks have left the financial needs of billions of unbanked and underbanked people in low-income countries unmet because they were considered too risky and too poor. However, mobile communication technology has allowed massive network to be built with extraordinary scale, which makes servicing these markets with low margin models possible. So telecoms and internet companies also face lower information asymmetry and risks versus banks when offering alternative financial services to the poor. For example, people may default on a loan, but they will never not pay their phone bill. So access to phone is essential in this age and time. So Safaricom and Vodacom, the two largest mobile network operators in Kenya and Tanzania, offer fee-based branchless banking services through M-Pesa, a mobile phone platform that I think a lot of people are familiar, that can facilitate payments and also money transfer, deposits, and withdrawals communicated via SMS text message. So cash withdrawals and deposits can simply make through point of sales locations and chaos. These kinds of added services further increase the stickiness of the customer. Alternative finance in the payments, crowdfunding, and peer-to-peer space is also largely unregulated, particularly when it comes to serving the global needy. All of this makes for very low compliance costs, which has helped these new services scale very quickly. In Kenya, only 5 million of the country's 46 million have a traditional bank account, but 19 million people have M-Pesa accounts, and this number is growing. And already M-Pesa expanded into Afghanistan, India, South Africa, and Eastern Europe. The competition is increasing too as more and more telecom and internet companies are investing heavily in fintech capabilities. This rapid press for innovation on the part of fintech companies and their investors is in stark contrast to the approach of the typical banking firm. Fintech firms innovate, explore, and recalibrate their offering rapidly. On the other hand, and I apologize to our banking colleagues there, the banking sector is plagued by a risk-averse culture, dominated by amply staffed regulatory departments and a financial control ethos, which I think the bank themselves don't really want that, neither do the regulators, but the trend is moving there. None of these characteristics scream innovation and disruption. So data is extremely valuable. In April 2015, a Singaporean telecom company announced that Singtel announced that it was accelerating its expansion into various digital lifestyle services offered through ASEAN. ASEAN stands for the Association of Southeast Asia Nations. And since these services run on servers and software, they can quickly scale to over 600 million people in these 10 countries. When an app's functionality is dependent upon users being part of a group or community where access to content requires user commitment, the switching cost for consumers becomes very high. The stickier the app, the richer the data it collects. Digital services like iTunes, Skype, WhatsApp can create huge captive user bases that generate enormous amounts of data. There's extraordinary value in this. And in 2013, Facebook bought the startup messaging service WhatsApp, which is it has 400 million active users. for US dollar 22 billion, despite the company have a loss of 138.1 million US dollar for the same year. There are 400 million users, and that could potentially be integrated into a fintech platform. Logistic companies which facilitate commerce and manage large swaths of valuable data are being acquired for huge sum as well. In a new economy, data is money. So since 2012, the growth in mobile transaction has been impressive. What is happening now is that some of these e-commerce companies are moving beyond simple payment, delivery, and settlement services. They're partnering with social media companies to provide lending, microcredit, investment products, insurance, crowdfunding, for movies as well, and for real estate and many more. Alipay, a payment platform in China's Alibaba Group, and the largest e-commerce firm in the world, has over 300 million users, active users. They have 800 million accounts open. And this 300 million is just half of total Chinese online payments market. The Tencent Group, owner of Tenpay, another large competitor in the Chinese payment space, has subsidiaries in social media, digital entertainment, the internet, and mobile services. In February 2013, China's insurance regulator approved a joint venture between Alibaba and Tencent in a partnership with the country's top insurer, Ping An Insurance, to launch an online-only insurance company, Zhong'an Insurance. Almost 2 years later, on November 11, 2014, this giant would set a new record. The record was set on China's biggest retail shopping day of the year, and it's called Singles Day, 11 November. In that day alone, Alibaba recorded sales of more than 9 billion US dollars, over half of which was facilitated by Alipay. And these numbers were actually collected, helped Alipay collected, Zhong'an Insurance collected RMB 100 million in online insurance premium from companies, from just having 50 cents insurance policy covering package delivery. At such large scale, even the smallest margin become lucrative. Internet companies have an information advantage that provides them with an intimate understanding of the consumer. It paints for them a more accurate picture of a consumer's potential financial risk versus what their more traditional peers can perceive. Because of this, these companies can disrupt the financial sector by lending and insuring at a lower cost. And given their inherent scalability with no need for brick and mortar branches, this reduced cost can be multiplied and passed on to millions of previously untapped customers on a low margin, fast moving model. Profit thus becomes secondary. Fintech companies grow by reaching out to the masses, diversifying service offerings, and disrupting further up the value chain. This attracts even more capital. Alibaba has been offering low-cost loans to merchants for years. They have since branched out into microloans for consumers because transactions between buyers and sellers take place through an e-wallet like Alipay. Alibaba is able to quickly assess a company or individual's cash flow in real time. Low interest rate loans of 30 days to a year are approved within 24 hours. A traditional bank would struggle to do that. Consumer credibility can be analyzed in very fine detail. Loan approvers can look through historical data where years of spending patterns can be observed. Not only that, but social networks in collaboration with fintech companies can even evaluate the creditworthiness of applicants based on whom they associate with, and maybe even what kind of content they search for and consume. This has mostly been for small, short-term, low-rate loans, but so far the default rate has been very low and below 1%. If you look at the next slides, the new banking services focus on customer needs and ability to raise funds. And basically, the compliance costs are low when fractional reserve banking is not involved. More importantly, the peer-to-peer lending democratizes the lending process and allow the buyer to match, the borrowers to match the lenders, and they can get access to credit within hours. And at the same time, letting the lenders earning returns in excess of the coupon rates. Lending Club is a good example. They facilitate unsecured loans up to 35,000, and with that business model, they are able to raise 900 million in 2014, and similar services are provided everywhere else in the world. And Singapore has a company called Capital Match, which also matches individual lenders to small and medium-sized enterprise. And if you look at cross-border remittances that charge for less than the traditional fees, there is a company called Transferwise, and it's gaining popular usage, providing remittance services at only 0.5%, which is much lower than the typical money transfer services of about 5 or 6%. This is achieved through crowdsourcing of funds, and by bypassing the requirement of foreign exchange, you save the market impact costs. So instead of facilitating a direct transfer from a sender to a recipient, what they do is that they just reroute payment directly from a sender to another transferor. And in this case, the disruption is happening from the bottom up. So you can see the powerful trend towards financial disintegration, and eventually some has predicted that there will be a completely distributed financial system, even though it's going to be a long way away, maybe 30 to 50 years. And blockchain is very much in discussion. I'm sure in conference, a lot of people will be discussing about blockchain, and over here in Silicon Valley as well. And it is a distributed database technology that makes public ledger or transaction for cryptocurrency and different asset classes and beyond possible. And it is known to be a bit more secure because hacking will need to overcome security protocol at each node, which are communicating with each other. And that is going to be extremely costly for whoever to try to hack to know all the passwords of each node or the private key of each node. Well, not all will agree cryptocurrencies can be self-regulating, democratizing the function of the central bank, and blockchain can remove the need for clearinghouses or custodian bank. So we should see some of this happening in the next few years, or maybe in the next 5 years. And in Thomas Piketty's seminal contribution in his book, he has demonstrated that the rate of return on capital is always greater than economic growth, and people without asset are always left behind. So by printing money, asset inflation driving the rich-poor divide even further apart. And one type of asset that inherent to all human beings exists, and that is actually the data generated every day by the individual. So there is a new economy now where data is an asset class, and although internet companies get to profit off this data, users can also take ownership and gain monetary benefit by contributing this data to Facebook, which then is owned by one company. But if it's decentralized, where the contributors themselves benefit as a shareholders or crypto equity holder of the company, like the company called GEM, then basically the user themselves will benefit from this. So P2P plus crypto equity may be equal to asset sharing economy. So a complete disruption of the financial system may happen in maybe the next 50 years. The continued growth of this sharing economy, the rise of P2P platform and cryptocurrency are facilitating this disruption. And the end result could be the decoupling of the traditional economy for this sharing economy. And within the sharing economy, you could see that there is service sharing economy and asset sharing economy, but the asset sharing economy may dominate the system in which control and ownership of the economy is democratized. So disruption could come from companies that embody the following characteristics, which I call it LASIC. Basically, it stands for L stands for low margin and low barrier entry. A stands for asset light. S stands for scalability. I stand for innovative. And C stands for compliance easy. So in conclusion, I didn't have time to talk about China, but China has got over 90% mobile phone penetration, and it has over 60% digital banking penetration, and the P2P market more than 5 times of US, and is leading the financial innovation space. And the bank is fighting back, and Chinese banks are transforming rapidly with the online and offline e-commerce platform activities. And it says ICBC is now the second largest e-commerce platform, just behind Alibaba and above JD.com. And the supply chain financing is taking shape in China. Education and government supply chain, real estate, medicine, and law are beginning to be distributed as seen in China. It is clear to me and to many who are observing China that current servicing sharing economy world is on the verge of next disruptive wave, and perhaps from a programmable through blockchain as an asset sharing economy, and adopting the LASIC with connectivity inclusion. You can't just do LASIK, but you have to connect for more people to come in, for the economy to grow, to serve the excluded. I think that will be the main feature of sustainable fintech business, just like Alipay and M-Pasa. So with that, I will end my 20 minutes presentation, and I would like to acknowledge the tech team who is making this streaming possible. And once again, I'd like to welcome you to this conference, and also that to thank those people who helped this research possible. So, well, I wish you very fruitful and enjoyable 2 days. And I'm sorry that I'm not there, but I'm sure you have a good time. So thank you very much.